Welcome. My name is Erik Brenner. I'm President and CEO of Hilltop Wealth and Tax Solutions, and I'm really glad you've joined us today on this webinar. And it's going to be a topic of tax mitigation for higher net worth investors. We're really excited to put this together, and this will actually be a two-part webinar that we will talk about more and our next date coming up. But I don't want to hold you up. I want to get into the content. So let's get started. Okay. As I had said, that is going to be a two-part series, tax mitigation strategies for higher net worth individuals. And let's talk about what's important and what you should know about our firm. Our firm is a registered investment advisory firm, which means we must always act in the best interest of clients, and we don't take commissions. We are based in three major areas. One area is Northern Indiana. Our home office is located in Mishawaka, Indiana. We also have an office in Fort Myers, Florida, and an office in Royal Oak, Michigan, and we are remotely around the country. We are fully independent, so our decisions we can make quickly, and we're not forced at all to sell any one particular product. We do work with institutional custodians like Charles Schwab. We really have comprehensive experience as an advisory team, and we're always about wanting to be transparent. So what this is going to be is a two-part webinar, as I said earlier. And we're going to cover these high-level tax mitigation strategies. And I'm just going to assume that probably you've not heard of most of these strategies. These are strategies that are not talked about day to day. And so I'm just going to assume that, they're new to you or somewhat new to you, or maybe you've heard about a strategy or two, but we're going to dive into them a little bit more today. Our next webinar with these tax mitigation strategies will be specific around the opportunity that's often overlooked, but's been around in the tax code since 1978. So for those of you who are clients, I want to thank you for allowing us to guide you along your financial journey. We really appreciate you as a client and continue to look forward to working with you and helping you make good financial decisions. If you are new to Hilltop, we'll share with you at the end how you can take the next step if you've got additional questions. I want everyone to know this is not a sales presentation. You're not going to be asked to buy anything. And we do not take commissions on any investment products, which we already talked about. And we only advise that these strategies are implemented with a comprehensive ongoing relationship and a plan. What can be really dangerous is if you integrate one of these strategies and you really don't have a good plan in place, it can backfire on you. And we don't want that to happen. So let's talk about what is tax mitigation. Tax mitigation is different than tax deferral, okay? Mitigating taxes is the process of legally reducing your tax liability through proactive planning and strategic financial decision making. It's critical that these strategies are implemented within a well thought out plan, as I had said, and executing them independently really can lead to inefficiencies, compliance issues, and just missed opportunities. So I'd really want you to think about this is not tax deferral. This is about tax mitigation. So let's talk about these advanced strategies and techniques, okay? These strategies used to be available only to the ultra wealthy. And over the past few years, there continues to be more strategies that clients like yourself can utilize. So, it used to be for many, many, many years, the ultra wealthy had strategies that were just not available to us. I often get the question, how do I hear about every now and then one of those real ultra wealthy families or ultra wealthy individual pay very little in income taxes? And I always tell people, there's a couple of reasons for that. There's more than a couple, but there's two big reasons. One is that they have really, really smart people working for them and oftentimes working for them full time. Second reason is they know the tax code and they know the access. The access is how do they get to these strategies? What are available? Okay. Well, what's happened over the last few years is a lot of these strategies have been brought down to more what we call middle income America. And middle income America, you still need to qualify, but it is certainly available to more folks than what it was even 5 to 10 years ago. Many advisors, or most advisors, cannot discuss these strategies for a lot of reasons. One is they may not know about them. So I often run across the situation where the advisor really did not even have a sense that that existed. Oftentimes, their firm doesn't allow them to talk about it or discuss these strategies. They also often do not have an integrated tax team. The tax team that really works on the planning part. So it's really important when you're doing these mitigation strategies that you are tax planning the year that you're in to determine whether or not they make sense for you. So at Hilltop, we have a fully integrated tax team. It includes tax preparation, but tax preparation really is putting the numbers in the box. It's not planning, nor is it tax strategies. And then we'll also work, if you have a CPA or an accountant, we'll work with them as well, real closely on your situation to make sure that they understand it and it's in, in your favor and best for you. So, the world is full of investments. Okay. So you have stocks and bonds, mutual funds, exchange traded funds, fixed index annuities, precious metals, real estate, that could be public traded or private traded. And then you have private equity and private credit, and you have money market accounts, CDs, cash. There's other types of investments. But when we talk about mitigation, we're talking about something beyond what these things are. It's really important within your overall financial plan to have these at your core, but we're really talking about additional type of strategies that you can utilize. Look, if you're in retirement or you're getting to retirement, or even during your working years, taxes is going to be one of your biggest bills. Okay. We often find that folks are in retirement, tax is their biggest bill. And so mitigation of those and putting more in your pocket can mean a lot of money over your lifetime. So let's talk about some of these strategies and what they are. First off is that you can have tax efficient investments. Okay. So those could be tax free. Okay. Tax free as it relates to municipal bonds. Depending on your tax bracket, you could have tax free income, and you need to look at, okay, what's my tax equivalent income off of a tax free investment? And so it may or may not make sense. But a lot of times we see people doing things like putting money into a taxable money market account, and they're in the higher tax bracket. Well, ultimately, if they would have utilized something tax free, they would have increased their overall earnings on that amount or that account. Secondly, is capital gain and deferral and reduction. So there are accounts, and we run across them all the time, that has increased capital gains. So if they sell something, it's at a gain. And even though gains are at a lower, potentially lower income bracket, there's still strategies to be able to mitigate some of those maybe investments that have a large gain in them. So they may have a large gain. Other strategies to minimize capital gain. A lot of strategies around minimization of capital gain. A lot of times people think, well, I've got all this gain built up in my investments. There's really nothing I can do. And that just may not be the case. So you have like kind investment gain. You have portfolios that can be like kind and doesn't create capital gains. A lot of other options that are available to you. Renewable energy tax incentives. This is a widely overlooked, yet it has been around for a long time. And we'll talk about this. This is actually what we're going to talk about more in the coming weeks. Charitable tax planning and charitable remainder trusts. So these things, for those that it makes sense, the charitable strategies and the way to give to charity is often overlooked and should be considered. Conservation easements is a strategy that takes a lot of planning, but it can be something that can be of extreme value to somebody that is in a much higher tax bracket. And so basically, what happens with conservation easements are you're able to make a charitable contribution, but take a much higher deduction. So instead of making a charitable contribution and that's what you get to deduct. So an example would be if I make a charitable contribution of $30,000, typically that 30,000 is what I get to show on my Schedule A, on my itemized deductions. Conservation easements allow to take a much higher charitable deduction than that 30,000. Now, what happens with that is that how that is calculated and how the IRS looks at that in future years all has to be taken into consideration. But you can get a lot of leverage out of conservation easements. We run across a lot of clients that have stock options and concentrated stock holdings. So there is a multitude of strategies we can utilize to help reduce some of the concentrated stock positions with minimal amount in tax. We can do that utilizing a couple different stock option strategies. That certainly is out there and available to do, as well as some other strategies to reduce the concentrated stock. We've seen a lot over the last 8 to 10 years where somebody might hold a rather large position in one holding, one investment. And, that can be pretty risky for somebody to carry that much in one investment if a lot of their net worth is wrapped up in this one investment. And I don't care what it is or what you own, you need to still consider diversification because you never know what's going to go up, what's going to go down. And so diversification is really important. The challenge becomes if there's a lot of gain built up, how do you do that different than not gain built up, and how you go about dispersing that from that strategy? So we can deploy a lot of strategies there. One of the things I mentioned earlier with these mitigation strategies is access. So folks like you to gain access to the strategies that are available. And that's what we do as a firm, is allow and bring clients access to these different strategies. Um, Different strategies work different for different people, and they may not work for your situation, but just taking a look at them, having access to them is one we think critical component. Real estate tax strategies. So, if you have a piece of real estate that has gains built up in it and you want to sell it, you want to diversify, maybe you're selling your business, maybe you're doing something with that piece of real estate and you're concerned about the tax, there are strategies, 1031 exchanges. So, we hear it quite a bit that people have heard of 1031 exchange. What they don't want to do is they're not really interested in making a change to another rental property. Let's say if it's a rental property or multitude of properties, whether that's residential or commercial, often this is commercial, is what we're talking about. And they know that if they have the opportunity to sell it, there's going to be gain in that sale. And they really don't want to go into another, situation of being a landlord or owning other property. Maybe they want to simplify their life. There are a multitude of 1031 exchanges where we can take gain, substantial gain, in a sale of a real estate and move it into a 1031 qualified fund that fund manages a multitude of real estate. The great thing about this strategy is you defer gain, and you can defer gain and continue to pass it on. Secondly, is you can create an income stream. And so if you're in retirement, you can create an income stream. And guess what? You don't have to worry about collecting the rent. You don't have to worry about taking care of the maintenance and everything that comes along with it. And down the road, if you want to change your mind and you want to get out of that strategy, you can also do that. So, by us being a fiduciary registered investment advisory firm, we have access to multitude of strategies. And what you can be assured is we're not commission based. So, we're not trying to sell you a strategy. We help educate people and direct them as to what's best. There's a bunch of business owner deductions that's often overlooked. So we've seen business owner deductions to where they could actually have a retirement plan that would be structured in such a way that the owners are able to get in a lot more money, pre-tax. Because of their age and their workforce. There's also deductions within the business that's often overlooked. And so, again, being proactive is really, really important. And so that leads also to the qualified plans. So, a lot of times folks say, well, I'm a small business, I don't have a lot of employees. We have really good, solid financials, we have really good income. But what good is it for me to do any more plan than a simple IRA or a simple 401k? But actually, there is. So there are other strategies you could utilize. And what we do there is we're able to run the analysis on multiple strategies and show if someone puts this amount in, this is how much you're allowed to get in. And you're allowed to save, and you save taxes in the year that you do it. And oftentimes people are really surprised at the amount that they're actually saving. So let's talk about the stock option strategy. So the stock option strategy, you could have covered calls. So covered calls is a option strategy to where you can still own the underlying stock, but yet get a premium, get an income off of that stock. So think about owning an underlying stock, XYZ, okay, and you're not planning on selling it at this point, but yet you want to gain some additional income off of that. Covered call strategies could be a good way to do that. There's also collared strategies, prepared variable contracts, exchange funds. So a way to take highly appreciated stock and move into an exchange fund, defer the capital gain, roll that into the exchange fund, and then get diversification on that stock. We've seen a handful of times over the years where somebody has a large position in one stock and then that changes. And we have seen in situations where companies end up going out of business and they were a large company. Anybody remember the company Enron? Perfect example. Enron was a Fortune 50 company. One day a Fortune 50 company, the next day bankrupt. So let's talk about qualified opportunity funds. This is where we can defer those capital gains by receiving the qualified opportunity fund exemption. If it's held for 10 years, gains on the new investment are 100% tax free. 100%. Exchange funds, we talked about that, allows concentrated stock positions, right? to go to a diversified portfolio without triggering capital gains. I talked about the 1031 exchanges, really important there. That's often overlooked. There are some really nuances when it comes to these 1031s, including that you must have an intermediary identified. You cannot take possession of the sale proceeds. Cannot. And there are specialists that can help with that. And obviously, we work with those folks. And then we can get you into the right program. You want to be careful on those real estate trusts that you invest in. You want to make sure it's right for you, it's within your risk tolerance, and so forth. We already talked about municipal bonds, right? Interest that is tax free. And then oil and gas direct investments. So this is where you can actually invest money, okay? You can invest money and get an immediate tax deduction in the year that you make the investment, okay? So let's take a look at an example, okay? So what you're looking at here is you're looking at a case on the left-hand side. So if you follow the base case there, you'll see this was an actual case, and then we took the names off to protect the innocent. And you'll see that they have a pretty straightforward situation when it comes to their taxes. Okay, so pretty straightforward, right? Well, what they wanted to do was they were considering a Roth conversion. So if you look at the next, from 100,000 plus to then you look in the middle, the Roth conversion. They had heard about Roth conversions. They were considering a Roth conversion, and they really wanted to do a rather large Roth conversion. They just felt like, taxes, we don't know where they're going to go in the future. They're probably going to go up over time. And they just felt like they needed to do a large Roth conversion. Okay. So on a $500,000, kind of a rip the Band-Aid off and do it, you can see that now their income's at 644, which, by the way, puts their tax bill up to 150,000 plus, just on the federal tax from, not much overall based on their income. And they were also in a state that had state taxes. So one of the things that we talked about with them is maybe we should consider an offset. So an offset, what it does is we'll invest the money, okay, into this direct investment offset. You have investment money, you have assets. How you invest the assets may make a difference. And so we go and invest this money. We put 500,000 into the offset, and what you'll see is there's a $450,000 offset, which brings their tax back down, okay, to what we would call a reasonable amount versus paying 156,000. They're down into the 16,000 range again. Big difference. Okay. Big difference. Sorry, 26,000. So these kind of offsets are there. They're used all the time. They have been used for years. We use them very successfully in certain situations. And so if you have more income in 1 year, if you have much more income in 1 year or expected more income, selling a business, Roth conversion, other income distributions, we highly recommend that these kind of offsets are considered to help reduce overall tax liability. So let's talk about a solar credit strategy, okay? This allows you to offset your active and passive income. And how this is done is by redirecting the money that goes to Uncle Sam, okay, and purchase, okay, the solar credits or purchase solar. So I'll say that again. Unlike other investments where you make the investment from an investment portfolio, okay, this allows you to take what you're paying to Uncle Sam, and instead of paying it to Uncle Sam, okay, you pay it towards solar. Now, what's the advantage of it? Well, the advantage is that you can get approximately a 30% lift. So what that means is that if you're going to owe $100,000, you could put in about 70 to 75,000, depends a little bit on the state, but let's call it 30%. You put 70,000 into solar, okay? And that will give you the $100,000 credit that was needed to offset what your 100,000 was. So there's a $30,000 lift there. This is a huge, powerful strategy. Large companies, Amazon and many, many other companies have been doing this for years. And in fact, okay, this strategy has been around since the 70s. We're going to talk about a little bit more when we're going to have a webinar on this strategy coming up here in just a short period of time. But I highly encourage you to tune in and hear more about this particular strategy. We just felt like we could go deeper on this strategy. I'm going to have an expert with me talking through this strategy and really what it could mean to your situation. So here's what this is not with solar and what we're talking about. This is not a fund. So we're not talking about investing into a fund that owns solar. Okay. This is not a security. So you're not owning stock in a solar company. Okay. It's not a tax deferral program where you have to repay. So I know of folks, and I've had clients that buy solar, put it on their house. They collect the energy. What they don't use, they move it back to the grid and they get credits. So they sell it back to the grid. That's not what we're talking about. And this is not solar panel for your house. We're not talking about going out and utilizing the strategy I just mentioned. So the session 2, we're going to dive much deeper into this. And that session is going to be on Friday, May 16th at 4 o'clock. So you'll see some communication on it. I would mark your calendars and we'll dive much deeper into this strategy. So I want to talk just briefly about your financial life and how we see it and how we go about helping people. So we look at the analogy of your financial life as a mountain. So when you're saving, investing, and kind of working hard, paying off the house, putting kids through college, kind of doing the things that we do on our day to day prior to retirement, we're working up the mountain. We're climbing the mountain. Then you get to the top and you start coming down. That's really where difficulty can come into play. You can have multiple different income streams taxed differently. Do you realize that in mountain climbing, a majority of the fatalities in mountain climbing happen on the way down? They don't happen on the way up. And so just like coming down a mountain, one little slip, you can fall several hundreds or even thousands of feet. In retirement planning, we look at it as the same way. In these mitigation strategies is why not take advantage of what is available to you? What's not going to happen is Uncle Sam's not going to send you a letter or call you and say, hey, have you ever considered this strategy or that strategy? Okay. It's really important to take a proactive approach. What we do at our firm is we act as the client's personal chief financial officer. So from financial to retirement projections to insurance planning and making sure that all the right insurances are in place. Taxes, we talked about preparation, year-round tax planning, tax mitigation, estate planning. So from start to finish, okay? Including making sure that your estate plan is properly, the strategies there, and then it's properly funded. So I think about estate planning in kind of three areas or three steps. The first one is documentation, getting the proper documents in place, making sure those are proper for your situation. Secondly, is strategy, making sure you have the proper strategy in place and you're utilizing the proper strategies. And the last one is funding, okay, and implementation. This is often overlooked. If you have number one and you've got the documents, funding and implementation is often not done. And then asset management. So, of course, managing assets, making sure that it's within your risk tolerance. Many of these strategies come with an investment component because if we're managing that, we have to manage the risk of owning an individual security, as an example. But it's really proper to make sure that you have the proper asset management. There's been multiple studies done on what is the value of a fiduciary relationship. And we really bring it in kind of three areas. One is this integrated approach for tax, estate, and ongoing portfolio reviews and integrate that piece. And then we have a customized approach that we bring to the situation and working with people. And then there's the matter of the what you spend, right? And long-term perspective. And the recent studies showed that it can mean as much or more than 4% added to your overall portfolio by not making the decisions or making mistakes with your decisions. I always tell people it's easier to avoid a problem than it is to fix an existing one that's already happened. And this is where we come in with a proactive approach. Okay. Well, I got a question for you. If you're new to Hilltop, when's the last time your advisor asked you for your tax return? Guess what? The answer when I ask that question is almost never. Almost never. So I ask you, how can they be a comprehensive financial advisor if they don't understand your tax situation? I got to tell you that in 31 plus years of doing this, going on my 32nd, there's no way they can be comprehensive in nature if they don't understand the core and where your taxes are coming from and looking at it on an ongoing basis. It's really important to remember that what I mentioned here today is a matter of fact. So all of these mitigation strategies are based in the code, they are factual. Investments is a matter of opinion. So if we opened up the live chat today and we started saying, what's your favorite investment? What don't you like? We would probably have all kinds of opinions, and that's fine. You can get it done with multiple different investment strategies, but taxes are a matter of fact. So, what do you do if you want to find out more? The next step would be to take and set up a 15-minute introductory call. Really think about, if you're new to Hilltop, think about getting a financial checkup. Work with a professional like Hilltop. That's a fiduciary, okay? That we can look at your entire situation and you're not going to be sold anything, okay? And there's no commissionable based investment products. And we'll give you a third party fiduciary analysis. So it's real easy. If you're a current client, you can reach out to your wealth advisor if you've got questions after you've watched this. We can talk about them. You've probably talked about many of the strategies along the way. We are also always looking at other strategies or how we can enhance strategies. We're working through that all the time, and there are new things that come into the tax code that we then will integrate into a situation. If you're new to Hilltop, we invite you to go to our website, hilltopwealthtax.com. You're able to go on schedule a 15-minute introductory phone call. We'd be glad to talk to you, find out more about your situation. You can find a little bit about Hilltop. And then from there, we can determine whether or not we'd move on to a conversation with one of our wealth advisors if it makes sense. What we will guarantee in that initial meeting, that initial 15-minute, as well as the initial conversation meeting with the advisor, is you will not be asked. We're not making a commitment. We can help you, and you do not have to make a commitment to us. But it's a way to find out more about each other and whether or not it makes sense to work together. So with that, I've covered a lot of information. I really appreciate you joining today. If you're watching this now, this will be and is recorded. Should have said that earlier. And we'll put it out so that I can have access, after the airing. This is complicated stuff. I just touched the surface. Each one of those topics, I could go in deeper and deeper and deeper. But what we need to do is find out about your situation and whether any of them make sense for you. Don't forget to join us for our solar credit webinar. It's going to be a lot of great information. Until next time, thank you so much for watching, and I hope you have a great, great rest of your week and weekend. Thank you.